In this lecture, I want to clarify 3 points. First of all, what is profitability? Second, how do we actually assess it? And third, what are the main profitability ratios? Now, when it comes to the first point, what is profitability? Well, profitability is the ability of any business to produce earnings, but how do we actually assess whether a company is producing earnings? Well, let me give you an example. Let's say that you earn $4,000 net per month. That would be cool, right? Now, imagine that of those $4,000, you spend $3,000 each month for all the expenses related to your life, like your house, your car, and your living expenses. It means that you have $1,000 additional each month, and those are earnings. It means that actually as a person you are profitable. The same principle applies to company, although with company is a little bit more complicated just because company have many transactions each month. We have to look at its income statement to know whether a company is going to be profitable. And the first place where we want to look at it's our actually net profit. So when we look at the net profit and we see that the company actually has a net profit, it means that the company is profitable. When we see a net loss, it means that the company is not actually able to produce earnings. In other words, its revenues are not able to cover for all its expenses. Now, the way to assess profitability is actually through the income statement. Although if we look at our main financial ratios here, our main profitability ratios, which are the gross profit margin, the profit margin, the return on assets, and the return on equity, you can see that they are all expressed as a percentage, but the first two actually are metrics that we can find on our income statement, such as the gross profit over sales and the net profit over sales. The last two instead are a relationship between the income statement. For example, we have to look at net income, and the balance sheet because we have to look at the average assets of the company. Now, having said that, let's compute our first profitability ratio, the gross profit margin. The gross profit margin is given by gross profit over sales. Now, let's go on and let's compute it. We are going to take our gross profit from our income statement and then our sales from our income statement as well. As you can see, the gross profit margin in this case is very high, it's 86%, and this is a business which is very profitable. But the reason why we use the gross profit margin is because we want to know how the inventories are managed. And that's why this gross profit margin is especially used in retail and manufacturing, while the inventories are very heavy for the company. Now, why the gross profit margin and how the gross profit margin is connected to inventories? I mean, what does the gross profit margin have to do with the inventories? Let me show you. If we look at our income statement here, you can see that the gross profit is given by the revenues minus the cost of goods sold. Now, what are those costs of goods sold, also called the cost of sales? Well, those are all expenses that we have to incur to generate revenues. How can we actually know whether the inventories are well managed by looking at this number here? Well, you have to know that the cost of sales are actually connected to our inventories. In other words, when you buy inventories, therefore when you buy, let's say, raw materials, then you're going to use these raw materials to produce items, to produce goods. And this money, therefore, is going to be reported under your income statement. And automatically, once you produced those items, you're going to sell them. And therefore, that's how the inventories are tied to the cost of sales. And this is how the cost of sales is tied to revenues. That's why when you look at the gross profit margin, you actually know how the company is managing its inventories. And that's why a high gross profit margin, it means that the company is managing its inventories very well. Now, an increasing gross profit margin over time is a good sign. A decreasing gross profit margin over time is a bad sign. But what are the two factors which affect our gross profit margin? First of all, the sales. It means that if we are able to either increase the quantity of the items that we sell, or that we are actually able to charge a higher price, therefore to sell the product to a premium price, we are able to increase our gross profit margin. And on the other hand, also if we are able to actually reduce the inventories, or actually to manage our inventories so that with a lower amount of raw material we're able to produce a higher amount of items that we are going to sell. As you can imagine, this is going to increase our gross profit margin. So those are the two factors. But how do we actually know whether the company is performing well from the overall standpoint? Well, we look at the profit margin. The profit margin, which is given by the net profit and the sales, is going to tell us much more about the overall company. And therefore, if we get our net profit on the income statement and then of course we do the same and get our revenues from the income statement, you can see that our profit margin here is actually 19%. Also, this number is very high. It means that the overall company is very well managed, and therefore an increasing profit margin over time is a good sign. A decreasing profit margin over time is a bad sign. Keep in mind that also here we have two factors which can affect the profit margin over time. First of all, the sales. So we can either increase the quantity or the price, as it happens for the gross profit margin. On the other hand, we have to decrease the expenses. Now, the expenses are not just related to the inventories, but also to other expenses. Let's say, for example, that if we run an ice cream shop and then suddenly we're able to get a better rent from our landlord, we're going to lower our expenses, and those in comparison will actually increase our profit margin. Now, although the increasing gross profit margin and profit margin over time is a good sign, what we are looking for is especially stability. We want to make sure that those profitability ratios stay the same more or less over time, because what kills many companies is actually volatility. Now, let's look at the other two ratios, the return on assets and the return on equity. As you can see, those ratios put in comparison the income statement and the balance sheet. Our return on assets is given by the net income that we get from our income statement, and then our average assets, which are given by the total assets in the previous year plus the total assets in the current year, and then we divide this amount by 2. And that's how we get our average assets. Now, as you can see, the return on assets here is 9%. It's a very good one. Why do we actually use the return on assets? Well, let me give you this example. Let's say that you bought an apartment and you paid this apartment $100,000. But the only problem is that you live into this apartment, and now this apartment is not generating any profits for you. Actually, you pay a lot of expenses like the mortgage, and also the other expenses for the maintenance of the apartment. It means that your return on assets is actually negative. Therefore, it means that you're not a good manager because you're not able to produce profits with the assets that you have. Therefore, you're not able to generate income with the money that you invested into the assets. The same logic applies to the company. We want to know whether the managers of the company are able to produce profits with the money invested into the assets. For each dollar invested in assets for the business, we actually are generating 9 cents of profits. A return on assets which is higher than 10% is definitely a very good sign. Lower than 10%, it really depends, and you have to look at the competitive context. The problem is that when you have a return on assets which is negative, it means that managers are not capable of producing any profits with the money invested into the assets. Now, as you can imagine, an increasing return on assets over time is a good sign, and a decreasing one over time is a bad sign. Let's look now at the profits that the company is producing for its shareholders, therefore the return on equity. The return on equity, which is given by the net income that we get from our income statement, the average shareholders' equity, which is given by the equity in the previous year plus the shareholders' equity in the current year, and then we divide this number by 2. And as you can see, our return on equity is actually 14%. And this is a good sign. When you see a return on equity which is higher than the return on assets, it's definitely a good sign. We're actually giving 14 cents of profits. We're actually generating 14 cents of profits. Now, if we assume that there is 100% payout, it means that the company is actually distributing 100% of the profits each year. As you can imagine, as shareholders, you're going to get your capital back just in a few years, thanks to the income generated by the company. That's why this is a very good sign, and when we see an increasing return on equity over time, it's definitely a good sign. The decreasing one, it's a bad sign. But again, what we look for when we look at the profitability ratios is stability.